By the end of this video, you should be able to spot opportunities like this that will make you $2,000 every day on a $100,000 funded account. Hello guys, my name is Ghislaine and welcome to Forex Hybrid family. Kindly subscribe as I upload videos daily and join my free Telegram, links in the description below. This strategy is called the FVG strategy. FVG stands for Fair Value Gap Trading Strategy, which is one of the strategies discovered by ICT himself. Of course, I've added and subtracted a few things. I've added and subtracted a few things from it, but that doesn't still make it my strategy. So my job here is to make it easier for you to learn. So sit tight. This video will be quick and straight to the point. Okay, like I said, let's rush through this video real quick. So here we are on the plain sheet. So this is gold. XAUSD stands for gold. All right, and we are trading on the 2-hour time frame. This time frame is perfect. I mean, for an intraday trader like myself, this time frame is perfect because it reduces the amount of trades that you take, and it also does not keep you hanging for weeks, or if not literally weeks before setups form, because the strategy that we are using does not really have setups back to back or every minute and then. So it's something very, very specific that we look for. That is why it is very, very effective, because it's not just all over the place. It's not easy to find, but when you find them, it's a very, very high probability setup. All right, I'm talking about something with 80% win rate if you enter and exit, if your entry and exit strategy is on point. Because spotting an opportunity and taking a trade is different. When you take the trade, leaving or getting out of the trade but profitable is also different. The market fluctuates up and down very frequently, so you need to get in and get out in a very, very, very smart manner. So the first thing that we want to do is identify the trend, right? Identify the market direction. And if you're watching this video, I believe you should understand the basic concepts of order flow, the basic concepts of market trends, right? So we need to know how or where the market is trending to, right? So now, first off, let's start off with this price leg. This is all we're working with here today, guys. So we are not going to be doing a lot of changing or transitioning on pages. I just want to explain on this particular price chart so that you can understand it very well. Do not be in a haste to click off. This video is, you're not paying for anything, you're watching it free, and I'm about to give you guys something very, very, very valuable. Okay, so this is the price leg. What do we see here? First off, I can see a clear uptrend, right? We have a low, we have a high, we have a higher low, we have a higher high, a higher low, a higher high, higher low, higher high. Watch it, pay attention. Then we have what? A lower low. Instead of a higher low, it has changed to what? A lower low. Then we have a lower high, then we have a lower low and a lower high again. Okay, let's look at this. Look at this pattern. Look at this thing I just drew. I just added it right now. All right, look at it. What can you see here? You can clearly see that the market was trending up, right? Trending up, trending up, trending up. Then when it got to this point here, what happened? It started trending back down. Why? Because it took out all of these lows here. All of these lows were swept out. So the market has changed its character. It has changed its structure from bullish to bearish. Beautiful. Now, let's go ahead. So this is an uptrend right here. This is an uptrend. If I draw my trend right here, you see that this is clearly an uptrend. But now here, the trend changed. It reversed. This is called a retracement. And on a larger time frame, this is a retracement, a pullback. The market continues trending back up. But now that's not what we're concerned with. Okay, when trading the FVG strategy, right, you don't really care what the extreme large time frames are saying. I understand that top-down analysis is a thing in this trading industry and stuff, but honestly I don't use it, and I'm profitable. I'm very, very profitable at that. All right, I just trade what I see, and the 2-hour time frame has a lot of information. It has enough information for me to go off with, so I don't necessarily need to go on a larger time frame. I see what I see here and I work with it. All right, I'm not trying to hold a trade for weeks. I'm taking a quick trade and I'm out. You feel me? Now let's do it. So here we have a nice uptrend. Now, if to say we have okay, now let me show you guys what we're looking for. Let me move this so I can show you guys what we're looking for. This is what we're looking for. Yeah? We want to see the market trend. Sorry. I want to see the market trending up like this. This is in an uptrend scenario. Okay. I want to see the market break structure like this. This is a break of structure. Then the market come back, retest it, and then pull back up. Now, this right here is our entry. That's my entry price leg. I want to see a fair value gap. I want to see what? A fair value gap. I want to see an imbalance on it. Once I see that imbalance, I'll trade it. Why? Because the market broke structure, putting us in what? In a bullish market. And when you're in a bullish market, you want to buy. You feel me? So our imbalance preferably should be somewhere around here. When the market comes back to fill up that imbalance, because when the market leaves behind these imbalances, or they call it imbalance, you can call it imbalance or fair value gaps. But when the market leaves behind these spaces, the market comes back to fill them because it is inefficiency. The market always fills empty gaps in the market. The algorithm, it redirects, or I don't know how it works, but from what I know, it always comes back to filling these spaces that it leaves because the price moves too quick that it does not fill these gaps. It's very, very important. All right. Now, let me show you guys what an imbalance looks like on a candlestick. Let me draw it here before I show you on an actual candle. All right. So let's just assume that this is an uptrending market like this, something like this, something like this. All right. Now, let me put weeks on it so that it's going to look more, these are weeks. This is a week right there. This is another week here. Then we have weeks on this middle candle as well, right? Wow, I think this looks really nice. Beautiful. Now I want you to look at something here. This here, sorry, you guys should bear with me here. I'm a trader, I'm not a teacher. All right, so this here is a perfect efficient market. It is efficient because there's no gaps. It's perfect. Everywhere has been filled. Let me draw the inefficient market, then you see the difference, then you easily understand. All right, bear with me. Now this is another week. Let me just put another candle so that it's going to really make sense. You see that there's no gap, there's no space in between. This week has overlapped with this week. You feel me? This middle candle here is where you're looking for the gap. This week has touched this week, it has overlapped. The same thing here. This week has also overlapped this week. These candles have overlapped each other. So there's really no space. You understand? Now let me draw another example with spaces on it. All right. So we have candle. We have another candle. Let's see here. The candle comes out here. Nice. Candles that you have inefficiency or you have imbalances on them or fair value gaps. Candles that often have fair value gaps. They're always like huge. They're always big sometimes. Yeah. So we'll draw another one here. Exactly. Beautiful. Now let me draw something here, guys. Pay attention and see something. You see the difference. I want to see it. Boom. You know exactly what I'm talking about. Look at that. Look at that. Now, let me explain. You see this one? You see this one? This is inefficiency. This is inefficient. This is efficient. Let me repeat. This is inefficient. Sorry, this is efficient and this is inefficient. Now, why is this one inefficient? Where is the gap? If you pay attention, if you look at these candles very well, like I said, these candles here overlapped each other, right? This one, this candle, and this candle, their wicks overlapped each other. This candle's wick and this other candle's wick overlapped each other. So there's no space. Now we see this happening. We see one candle standing on its own without any wick touching each other at the side. This candle's wick is not touching this one. There's a perfect gap. There's a space in here. This space is called imbalance. It's called fair value gap. So this is the gap that you want to fill. In some cases, even this candle will not even be there. In some cases, it just be empty like this. Sometimes when the market just skips, you leave this gap empty, no candle. But most of the time, it's going to have the candle. But still, it is an imbalance because why? This wick did not touch this wick, or this wick did not touch this one. It left a space in the middle. This is imbalance. Up here, there's no imbalance because why? This wick and this one overlapped each other. But here, there's an imbalance. Okay? So I think that's perfect. Even a complete blind, a deaf person without hearing anything, they'll clearly understand what I'm trying to say because really, it makes a lot of sense. Now, this is a fair value gap. You've seen it? Perfect. Now, this is what we want to trade. What we want to happen now is I want the market to come back and tap into this fair value gap. This is where I'll place my buy order. I'll place buy limit here. When the market taps this, I want MS to continue bullish, right? Of course, I'll be doing this only if this market has broken structure here. So we should be having something like this. We should have something like this, Then this should be like the break of structure right here. Once the market has broken structure like this to the upside, boom, I'm expecting to buy here. Perfect. I'm sure this thing makes a lot of sense. Please tell me you understand. All right. Now, let me go on a real candle and show you guys exactly how it is. All right. So, yeah. So, like I said, we've identified the trend. We know exactly what trend it is. It is an uptrend. Now, let's look for buys. Looking for buys, let's start from here. We can see the market has pushed up. Then we have a break of structure right here. Perfect, right? we draw our lines. These lines here is to demarcate exactly where the market was the structure was broken, right? So BOS stands for break of structure for sure. So structure has been broken here. Okay, we keep looking. Is there a fair value gap? Yes, there is. This is a fair value gap right here. This is a fair value gap. Now, what I want the market to do is to bounce back on this fair value gap and continue up. But the market failed to do that. All right, if you look at it very well, you see that the market failed to bounce back on this gap, trade fair value gaps, but they trade only. If you have to trade every single gap in the markets, you will lose all of your money the same day. I promise you, because there's gaps every time. Every time there's gaps, the market leaves gaps. They don't trade all the gaps. This is an example of a gap that you don't trade. Why do you not trade this gap? Because the market left it and did all of these movements here, cleared out all the inefficiencies up here before coming back down with a lot of volume. So it has picked up, cannot hold it. It's coming down too quick. When the market is coming down too quick, it cuts through points of interest. It cuts through your point of interest with like a sharp blade. It does not stop because there's too many orders and it's flooding. The film is heavy. So you want the market to break structure, then come back now to rest and rest inside this level gap. Then you buy immediately. So this move, this is where we're supposed to enter. But it did not enter well enough for you to activate your order. So you have missed out on the trade here. So now when this happens and the market continues driving, it's still going to work in the future, don't get me wrong. But the higher likelihood of this thing working is when it breaks and taps it back immediately, or at least a few candles then immediately. Let it not go this far. When it goes this far up, trust me, bro, it's not going to work. Trust me. All right. Now, so this here is an invalid level. All right. It was a fair value gap, but it's invalid. Now we continue searching for invalid levels. The market is trending up, comes down, it breaks structure right here. This is a break of structure, guys. Break of structure to the upside. Then there's another structure break here. Excuse me. There's another structure break here. Beautiful. And then the market now breaks, changes character to the downside. This right here is the change of character. A chalk. This is the low. You highlight it like that. Beautiful. Now we label this as chalk. COH. COCH. It stands for chalk, right? Change of character. That means instead of the market continuing bullish, it is now changing, it's shifting its direction bearish. It's breaking structures now to the downside instead of the upside. You see, it was breaking here, going up. Now it's breaking, coming down. So the market now is bearish. Now that we're in a bearish market, we are looking for sells. As this market changed its character or its structure to the downside, where do we see the imbalance, or do we see any imbalance at all? Yes, there's an imbalance right here. This is our imbalance. You see this wick? It did not touch this last wick here. There's 1, there's 2, and there's 3 candles. There's a space on this big candle. Why? Because these wicks did not touch each other. Now, this is our imbalance right here. We'll draw them like that. Boom. Put it there. Fair value gap. Right? Now that we have our fair value gap, where is the trade? This is the trade. You see what I was telling you guys? Do not allow this thing to go all the way down. Then on its way back up, you're struggling to catch it. Trust me, you will not survive that. You will not survive that unless you have like billions of dollars sitting there. You will not survive it. All right. So now we are waiting for the market. When the market breaks it, immediately the market came back to rest. You can look at this candle. It shows you a lot of momentum. It shows you a lot of volume has been traded here. The market will not continue order volume because there's not enough rich people out there to trade like this. There's not enough banks out there to keep this thing going. You feel me? These small candles is like you and I, but these huge candles are these guys. You feel me? And when they just put these orders like this, they run the market, then they cool down. That's how it works. That's why these candles cannot just come out consecutively back to back. No, it comes out once, then it rests. You see now, so when it came here, it went back to the filling station, picked up some more, then it continued again, went back up. That's how it works. So on its way back, immediately as it's shattered this low here and starts broken this low, on its way back, this is where you want to be. You want to catch this trade back down. Now, place your sell limit. This is how you place your sell limits. Let me tell you guys, my students, I tell them this all the time. Go for the midpoint when the fair value gap space is big. Like when you have a huge candle like this, go for the midpoint of this level like that. All right, but it's a small fair value gap like this one. You can put at the beginning, put your stop loss just below the candle that the fair value gap resides on. So here, where does the fair value gap reside? It resides on this huge impulsive candle. So where's our stop loss? Our stop loss sits on top of it. Perfect. Then I will aim for what? We can aim for 1:2. We can aim for the next low. We can aim for whatever you want to aim for. But I always advise for 1:2. 1:2 is very, very realistic. Nobody should tell you, oh, scale or hold your positions and stuff. You always get stopped out. Trust me. So hold your positions to 1:2. I think it's really good. On $100,000 accounts, this is 2%. If you are trading 1%, $1,000, you have $2,000 on this particular trade. And you have setups like this every single day. If you are trading all the other forex pairs, all the stronger pairs, of course, do not trade those weaker pairs. I'll give you guys a complete video breakdown. If you want that video, comment down below. A complete video breakdown of the forex pairs to trade. I'll give you guys the pairs that I personally trade. They are really good. So if you look at all of these pairs every day, at least one pair will give you one of these setups for you to trade every day. So this is it. If you also want me to make a complete video breakdown how to get funded with 100k, kindly leave me a comment, join my Telegram, and I'll make that video content. Okay. Now, this is our setup. Let's keep looking if we see some more, right? Okay, beautiful. Now we have another breakout structure here. Do we have a fair value gap? Let's look at it. Technically, yeah, we do. Technically, yes, we do. But I will not trade this one. Why? Because the candle that I'm expecting the fair value gap on is the candle that broke the level, and it's huge. And the way it closed out, it really doesn't really look like something that can be traded like that. If you mean, like, what I mean by that is, if you look at it, the gap is just enormous. It's enormous, and it's not really making any sense because this candle just came down, shattered its lows, and then the next candle immediately rejected with a very long wick. You don't really want to like consider this a huge gap, to me, honestly. I just think it's displacement. I don't want to be trading displaced candles like that. You feel me? Now, markets started reversing immediately. You can see that it entered the gap or whatever and dropped, but I don't really consider that a gap. So let's continue looking for better opportunities, right? Now if you look at here, I actually see another opportunity here, but it's an internal structure. We have a low here, an internal high. We have a lower high, sorry, a lower low, a low, sorry, it's not a lower low, this is an internal low. Then we have another internal high, an internal lower low. You feel me? Internal lower high, internal low. Then you see the structure is not clear. It's kind of consolidating back and forth. It's not taking major structure. But either ways, you can see here that we still have a fair value gap just right here. I don't know if you guys saw it. That's it right there. So when this tiny structure here, because there's a breakout structure either ways. A breakout structure is a breakout structure. It does not matter if it's internal or external. It's still a breakout structure. You feel me? So this is a breakout structure. That's your fair value gap. This is your trade. So if you place your tiny trade here, like I said, when the space is small like this, you can actually just take at the opening, not necessarily the midpoint, because why? The gap is small. It's not as large as this one. Now you can see right there, 1:2.06 for spreads and everything. Perfect. We have that's 4% right there. But I'll not say this is realistic. This one especially, sometimes you might not see this play in real life or in real time. But in real life, this is a perfect trade and you should be able to catch that. So I'll see you guys on the next one. I hope you guys really, really understood or grabbed at least something from here. If you enjoyed this one, smash that like button. If you do not smash this like button or encourage me to keep making videos, I will stop. So encourage me by commenting down below, like it, share it if possible, and check my description for links. I have a free Telegram you can join, and I'll see you in the next one. Ciao.